What to expect for markets in the next 6 weeks? Federal Reserve Chairman Jerome Powell fired a warning shot across Wall Street last week, telling investors the time has come for financial markets to stand on their own feet while he works to tame inflation. The policy update last Wednesday, laid the groundwork for the first benchmark interest rate hike since 2018, probably in mid-March, and the eventual end of the central bank's easy money stance 2 years since the onset of the pandemic. The problem is that the Fed strategy also gave investors about 6 weeks to brood over how sharply interest rates could climb in 2022 and how dramatically its balance sheet might shrink as the Fed pulls levers to cool inflation, which is at levels last seen in the early 1980s. Instead of soothing the market jitters, the wait-and-see approach has Wall Street's fear gauge, the CBOE Volatility Index VIX, plus 1.84%, up a record 73% in the first 19 trading days of the year, according to Dow Jones market data average based on all available data going back to 1990. Even with a sharp rally late Friday, the interest rate sensitive Nasdaq Composite Index Comp plus 3.13% remained in correction territory, defined as a fall of at least 10% from its most recent record close. Worse, the Russell 2000 Index of Small Capitalization Stocks RUT plus 1.93% is in the bear market, down at least 20% from its November 8 peak. Wait and see. Powell said Wednesday the central bank is of a mind to raise interest rates in March. Decisions on how to significantly reduce its near $9 trillion balance sheet will come later and hinge on economic data. We'll probably see a rollover on inflation by April, or price distortion common during the pandemic that make yearly comparison tricky. That will provide ground cover for the Fed to take a data-dependent approach. But from now until then, it's going to be a lot of volatility. Peak panic about hikes. Because Powell didn't outright reject the idea of hiking rates in 15 basis point increments or a series of increases at successive meetings, Wall Street has skewed towards pricing in the more aggressive monetary policy path than many expected only a few weeks ago. The CME Group's Fed Watch tool on Friday put a near 33% chance on the Fed funds rate target climbing from the 1.25% to 1.50% range by the Fed's December meeting, through the ultimate path above near zero isn't set in stone. It's a bidding war for who can predict the most rate hikes. Kathy Jones, chief fixed income strategist at Schwab Center for Financial Research, says, "I think we're reaching peak panic about Fed rate hikes. We have 3 rate hikes penciled in. Then it depends on how quickly they decide to use the balance sheet to tighten," Jones said. The Schwab team pegged July as a starting point for a roughly $500 billion yearly drawdown of the Fed's holding in 2022, with a $1 trillion reduction an outside possibility. There's a lot of short-term paper on the Fed's balance sheet, so they could roll off a lot really quickly if they wanted to, Jones said. Time to play safe? It's easy to see why some beat down assets finally might end up on shopping lists. Although tighter policy hasn't even fully kicked in, some sectors that ascended to decent height, helped by the extreme Fed support during the pandemic, haven't been holding up well. It has to run its course, John said, noting that it often takes wringing out the last pocket up front before market find the bottom. Cryptocurrencies BTC USD plus 1.57% have been a notable casualty in January, along with giddiness around blank check or special purpose acquisition corporation SPACs, with at least 3 planned IPOs shelved this week. Once the Fed is able to provide investors with a more clear roadmap of tightening, markets should be able to digest constructively relative to today, he said, adding that the 10-year Treasury yield, 1.780%, remains an important indicator. If the curve flattens substantially as the Fed raises rate, it could push the Fed to more aggressive tightening in an effort to steepen the curve. Climbing Treasury yield have pushed rates in the U.S. investment-grade corporate bond market near 3%, and the energy-heavy high-yield components closer to 5%. Analysts say that high yields at 5% are better for the world than 4%, adding that corporate earnings still look strong. Even if the peak levels in the pandemic have passed, the risk of a recession in the next 12 months is low. Overall, while inflation is at the 1980s high, consumer debt levels also are near 40-year lows.